Alright children, welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Fritz. Today we're going to talk about monetary policy in an ample reserves regime. So the first thing we need to consider when we're talking about monetary policy in an ample reserves regime is, well, what's the difference between a limited reserves regime, or the way that you already know how to conduct monetary policy, and an ample reserves regime? So the main difference between monetary policy in a limited reserves regime and monetary policy in an ample reserves regime is going to be how you change the interest rates. The way that you've already learned monetary policy or in a limited reserves regime, if you want to lower the nominal interest rate, the Federal Reserve would buy bonds, increase the money supply, and that would lead to a lower nominal interest rate. And if they wanted the reverse, they could sell bonds, decrease the money supply, and have a higher nominal interest rate. In an ample reserves regime, however, there is so much money that has been added to the money supply since 2009, or since the Great Recession, that now we're way out here on the demand curve for reserves, and increasing the money supply no longer has an effect on the nominal interest rate. So now the Fed, if they want to change the nominal interest rate, they have to change what's called their administered rates, or their policy rates. Let's talk about what the administered rates are real quick. On our reserves market graph here, and on the x-axis, we have the quantity of reserves. That's how many reserves there are. So right here, straight up and down, is our supply of reserves. And it's straight up and down again because the Federal Reserve is going to be in control of that. Over here, we are measuring the policy rate. This is the administered rates, the interest rates that the Federal Reserve controls, the discount rate and the interest on reserves balances. I'll explain those in a moment. And then this downward sloping curve is our demand for reserves. So up here at the top of the demand for reserves curve, it is going to be flat because there isn't going to be an interest rate that's charged greater than the discount rate. And then down here, we have a downward sloping curve for demand because as the interest rate goes down, the opportunity cost for using money as an asset decreases. First and foremost, the Fed still does conduct open market operations. The Fed will still buy bonds, but now instead of buying bonds to increase the money supply and lower the nominal interest rate, the Fed is actually just buying bonds to ensure that there are still ample reserves. So every once in a while, they'll increase the money supply to ensure that we still have ample reserves. The way they're actually going to change the nominal interest rate, though, is changing their policy rates. Keep in mind that the Fed is trying to affect the federal funds rate. And again, that's the interest rate that banks charge each other when they borrow money from each other. The Fed can't just straight up tell banks what they can charge each other, so instead, they have to change the nominal interest rate, or their administered rates, to try to get the federal funds rate that they're targeting. The Fed's administered rates, they have two administered rates that we're going to need to worry about. One is the discount rate. Remember, that's the interest rate that the Fed charges commercial banks to borrow money from the Fed. If Bank of America needs money, they can borrow from the Federal Reserve at the discount rate. For the sample reserves market, the discount rate is essentially going to be the upper bound of this graph. This is the highest interest rate that banks are going to have to pay if they need to borrow money, because the Fed sets it. And so if any bank is charging more than that to borrow, like if Bank of America calls up Wells Fargo and asks to borrow money, and they charge something greater than the discount rate, well then Bank of America is just going to go pay the discount rate at the Federal Reserve. The lower bound of this graph is the interest on reserves balances. So this is the interest rate that the Fed pays commercial banks when they leave their funds in an account in their reserves at the Fed. So if Bank of America saves money at the Federal Reserve, they're paid what's called the interest on reserves balances. That's the interest rate they're going to get paid for leaving their money at the Fed. And our federal funds rate is going to be somewhere in here. This is going to be our federal funds rate, the interest rate that banks charge each other to borrow money. So it's going to have to be something greater than the interest on reserves balances, because if Bank of America isn't willing to pay something greater than that interest on reserves balance, then Wells Fargo will just go leave their money in an account at the Fed. And if Wells Fargo tries to charge something greater than the discount rate, then Bank of America will just go borrow money from the Federal Reserve. So our federal funds rate falls somewhere in here. If the Fed wants to lower the federal funds rate to try to increase aggregate demand, then what they can do is they can lower their policy rates by lowering their administered rates. They can lower the interest on reserves, and they can lower the discount rate. Lowering the interest on reserves rates makes it less profitable for banks to leave their money at the Fed, so they might as well lend it. And lowering the discount rate makes it cheaper to borrow money from the Fed. That'll cause banks to be willing to lend out more money. All right, first let's look at what we would do to fix or close a recessionary gap. Remember, in a recession, our problem is that we have high unemployment. Real GDP is less than our potential real GDP, and so our goal is to increase aggregate demand and get people to spend money again. We need aggregate demand to increase, get people back to work as real GDP picks up and businesses hire people back. Now, the way that we would have done this in the past is to buy bonds, big money, increase the money supply, interest rate goes down, aggregate demand goes up, everybody's happy. But now, that's not going to do anything. Remember, this is an ample reserves regime, so increasing the money supply isn't going to do anything to our nominal interest rate. And so what we're going to do now is lower the Federal Reserve's administered rates. Remember, those two rates are the discount rate. So at the top of the graph here, we're going to have a lower discount rate. And that's the interest rate that the Federal Reserve charges banks to borrow money from the Fed. And then we're also going to lower our interest on reserves balances and make it where banks will get paid less to leave their money in an account at the Federal Reserve. So this lower interest on reserves balance, this is their big one. This is the one that they changed, lowering the interest on reserves balance is going to be the main way that they do this. Changing this lower part of the graph. They make it less lucrative to save your money in an account at the Federal Reserve, so banks are more likely to lend out money to people like you and me. As the nominal interest rate goes down, businesses and people will be more willing to conduct interest-sensitive spending. Aggregate demand increases and shifts to the right. And we close that output gap. We have a higher price level, PL2, but we have full employment again. The unemployment rate goes down, aggregate demand goes up, everything is great. So again, that lower nominal interest rate caused by lowering the Fed's policy rate, aka their administered rates, the discount rate, and the interest on reserves balances, lowers the nominal interest rate overall, including the federal funds rate, and causes people, consumers, and businesses to increase their interest-sensitive spending, and makes it less lucrative for us to save our money in some sort of interest-bearing asset like a bond or a savings account, getting us to spend more. Now let's look at what we would do in an inflationary gap. In this next example, we have an inflationary gap. Prices are getting too high. Our inflation rate is greater than expected. Our unemployment rate is below the natural rate of unemployment. We are worried about an inflationary spiral. So our goal is to decrease aggregate demand. We need to get people to spend less money. In the past, what we would have done is sell bonds, money supply decreases, nominal interest rate goes up, the opportunity cost for holding money increases, and so people like you and me are more likely to save our money in the bank rather than spend it. We're more likely to decrease our interest-sensitive spending, and aggregate demand falls back and everything's great. However, again, Fed can't do that in an ample reserves regime because if we decrease the money supply, nothing happens to the nominal interest rate. So what we'll have to do now is increase the administered rates, aka the Fed's policy rates, the discount rate, and the interest on reserves balances. So first thing we can do, increase the discount rate. So we have a higher discount rate. And we also increase the interest on reserves balances, and we end up with a higher nominal interest rate. The interest on reserves balances goes up. That means it's going to be more lucrative for a bank to save their money in an account at the Federal Reserve. The federal funds rate is going to go up too, and it's also going to cost more for banks to borrow money from the Federal Reserve. What that means for people like you and me, nominal interest rate rises. It is now more lucrative for us to save our money in some sort of interest-bearing asset like a savings account or a bond. It's going to cost more also to borrow money to conduct interest-sensitive spending, whether we're consumers or businesses' investment spending. What that does is that's going to make it less likely that we're going to spend money. Aggregate demand decreases and shifts to the left. Price level comes on down. And real GDP decreases. Unemployment rate goes up, but it's just rising back to the natural rate of unemployment. And we're back at full employment and everything's great, just with a higher interest rate and lower prices. So that was how we conduct monetary policy in an ample reserves regime. The most important thing to remember is just that the Fed is just going to change its policy rates, aka its administered rates, either the discount rate or the interest on reserves balances. But again, we can just call it the policy rates or the administered rates. I'll see you next time when we do something. Goodbye.